Welcome back. If you've been following our series, you know that we view retirement planning like solving a giant puzzle. You have all these different pieces, your income, your investments, Social Security, and more. But today, we need to focus on one of the trickiest pieces of the entire puzzle, taxes. Specifically, how taxes change when you are required to take money out of your retirement accounts. I get questions all the time about this topic from my clients here at the office and from folks who attend my live educational seminars. Everyone wants to know, what are RMDs, when do I have to take them, and how much will they cost me? Today, we are going to answer those questions and help you fit this piece into the retirement puzzle. Let's get started with the basics. What are RMDs and why do they exist? For years, you've likely been saving money in tax-deferred accounts like traditional IRAs or 401ks. The IRS allowed you to skip paying taxes on that money when you earned it, but now Uncle Sam wants those tax dollars. RMDs, or required minimum distributions, are the government's way of saying it's time to pay up. They require you to start withdrawing and paying taxes on that money. When do they start? Under current rules, RMDs generally begin at age 73. However, this age has shifted recently due to new legislation, so it's critical to know the specific rule for your birth year. The amount to withdraw is calculated by taking your account balance from the end of the previous year and dividing it by a life expectancy factor set by the IRS. As you get older, that factor gets smaller, which means your required withdrawal gets bigger. One of the easiest ways to calculate the amount is using one of the many online RMD calculators available for free. This leads us to the tax implications. RMDs are taxed as ordinary income, not capital gains. This means they are taxed at your highest marginal rate. If you have a large amount of tax-deferred assets, your RMD could be substantial. This extra income could push you into a higher tax bracket, which brings us to the ripple effect. RMDs don't happen in a vacuum. They can interact with your Social Security. If your RMD increases your income significantly, it can cause up to 85% of your Social Security benefits to become taxable. It can even trigger higher premiums for Medicare Part B and D. This is why you can't look at the tax puzzle piece without looking at the Social Security piece. They are connected. And very important, don't miss the deadline. The penalty for failing to take your full RMD used to be a whopping 50%. It has recently been reduced to 25% and can be even lower if corrected quickly, but that is still a massive penalty for a simple mistake. It's money you worked hard for, and you don't want to give it away because of an oversight. Now for the good news. This can be managed. You don't have to just sit back and take the tax hit. We help clients use strategies like Roth conversions to change their outcome. This involves voluntarily paying taxes on some of your money now to move it into a Roth IRA. Roth IRAs do not have RMDs for the original owner. This reduces your traditional IRA balance, which lowers your future RMDs and protects you from a future tax burden. My advice, start planning early. Don't wait until you reach 73 to think about RMDs. By then, you've potentially missed valuable opportunities. The sooner you begin, the better. Ideally, you want to start in your 60s or before. The earlier you start, the more options you will have to tailor your strategy for your specific situation. Early planning lets you take advantage of tax-saving moves and helps mitigate the risk of unpleasant surprises down the road. That covers the basics of RMDs. We hope you enjoyed this video. If you want to learn more, we encourage you to check out our Retirement Resource Center on our website. Or if you have a specific retirement question, you can schedule a free 15-minute call with me personally. Thanks for watching and have a great day.